Yeah, good evening, everybody. Welcome today to today's webinar, Practitioners Insight, Investing in Gold, hosted by the CFA Society India. I'd like to take a moment to welcome our audience from India and around the world joining us remotely. Hope all of you are staying safe during this COVID lockdown. My name is Kazi Zaman. I'm a partner at Gestalt Network, a Bangalore-based investment partnership, and I'll be the moderator for today's webinar. Some housekeeping notes to start off with. Before I introduce our speaker, please note that today's webinar is scheduled for 1 hour. We'll be ending at 6:30 p.m. Indian Standard Time an hour from now. We'll be leaving adequate time after Krishna's presentation for question and answers. Please feel free to submit your questions throughout the presentation by clicking on the Q&A link at the bottom of your viewer and typing your question in the box. This webinar presentation will also be available to you after the presentation. Link will be shared in the chat box. We value your feedback, so please complete the evaluation survey before you sign off today. It's my pleasure today to introduce our speaker, Mr. Krishna Hegde, CFA. Krishna is Head of Strategy of Setu.co, a fintech funded by leading VC funds, Lightspeed, Falcon Edge, and the Bharat Innovation Fund, which is the VC arm of the India IIM Ahmedabad incubator. Till end April, which is last week, he was the president consumer at MMTC PAMP. Many of you would not be aware of who MMTC PAMP are. MMTC is, of course, a well-known and large public sector entity. So it's quasi-owned by Government of India. And PAMP is one of the 4 largest gold refiners in the world based out of Switzerland. At MMTC PAMP, Krishna was responsible for minted products, digital gold and recycling businesses. Before that, he had leadership experience in other fintech companies, including NovoPay, where he was chief business officer. And before that, Paytm. At Paytm, interestingly, he was responsible for the launch of DigiGold, which is a product which he launched for Paytm in conjunction with MMTC PAMP. Before that, he had rich experience in the more conventional investment banking arena, where he was MD and head of Asia Credit Research at Barclays based in Singapore. And Krishna is an engineer by training with a degree from BITS Pilani, followed up with an MBA from the Tuck School of Business at Dartmouth College. And it's our pleasure to have him with us today. Thanks, Krishna, and over to you.
Thanks, Kazi. Appreciate the nice introduction. And thanks, everybody, for joining us today for this discussion. Obviously, there has been a lot of interest on gold. So what I will do is in the next 30 minutes, I will walk you through a presentation which we have about how we think about the gold market right now and gold as an investing option from an Indian context specifically. And subsequently, as Kazi said, we'll open it up to Q&A. So let me just kind of get the presentation available to you. Is the presentation visible, Kazi?
Yes, it's clear.
Wonderful.
Please go ahead.
Sure. So the way we will look at the presentation today is first we'll evaluate gold as an investment. Why do people invest in gold? Then we will talk about gold in the Indian context specifically, about how do people think about asset allocation into gold. Subsequently, we will talk about the Indian characteristics of gold, like how is gold priced in India, how is gold transacted in India. And finally, we will talk about the different options investors would have for investing in gold. And some of you may be advisors or advising clients, and how you can think about the different options to invest in gold as an asset. Now, in the context of this whole discussion, I want to highlight that I will not be making any viewpoint on whether or not gold is an appropriate investment in this point of time. It is not a discussion about whether or not to buy gold at current levels, but more about gold as an investment asset in itself. With that as the caveat, let me start. There are different reasons investors look at gold, and the reasons have changed over time. But at this point of time, if you look at the top few reasons why somebody would think about gold as an investment within a portfolio, the top reason always seems to be portfolio diversification. Because unlike a conventional financial assets portfolio consisting of stocks and bonds in any ratio, commodities in general and precious metals, of which gold forms a significant chunk, has very different characteristics with regard to volatility, with regard to returns, and with regard to response to external market conditions or economic conditions. So that's why gold behaves well as a portfolio diversification asset for many portfolios. The second reason, which is often cited, is as a safe haven asset. What I mean by that is whenever there is an increase in volatility, whatever the reason be, the reason could be a pandemic, the reason could be a financial crisis, the reason could be some kind of socio-economic disturbance within a country, there is a lot of demand for gold and gold prices tend to go up. Why is there demand for gold? A couple of reasons, and these reasons have stood the test of time. This has been true for hundreds of years or maybe even thousands of years. Gold is a very high value asset and physical gold is easy to transport. So you're able to transport a large amount of value in a very limited space. So if you think about the times when people had to flee from invaders or people had to cross borders due to some conditions, gold was an asset which you could take with you very easily. And it was also liquid and easy to convert into cash or whatever be the monetary kind of form everywhere in the world. That's why gold as a safe haven has been discussed frequently. Coming back to the more Indian context, where we've had episodes of inflation, and this is true across many emerging markets. If you look at Thailand, if you look at Brazil, if you look at Vietnam, there are lots of places where people look at gold as a hedge against inflation and depreciation in their currency, because gold is one asset which is traded globally. And whenever there are episodes of high inflation in a particular country, or when the economy's currency is depreciated heavily, gold tends to hold value and rise in value in nominal terms against the local currency. So that's the reason gold is viewed as a good hedge against inflation and depreciation of the currency. Subsequently, there is a huge discussion about the upside case of gold in a tail risk event. Now I will draw a difference between point 4 on the slide and point 2. So, a safe haven asset, I would say, is something which you use because it has got value in multiple different scenarios. Whereas the fourth point about upside and tail risk is more from a financial asset standpoint, because the thought process is that if there are scenarios like, where there is a global crisis and there is a lack of faith in every currency, which is, from different countries, then gold could be an asset which can have such significant upside in such a tail risk scenario. And the concerns about fiscal policies of different countries, monetary debasement, etc. So as a tail risk hedge, people look at gold. Finally, there is a case which can be made based upon upside and downside, upside of demand and the demand supply imbalance, if you may. Because if you look at the demand factors for gold, gold is used for jewelry, gold is used in electronics, gold is used for as an investment asset by individuals and funds, and a lot of gold is held by central banks. So the demand for gold tends to fluctuate, but the supply of gold is quite stable, because getting a gold mine on stream takes a lot of effort and it's a multi-year exercise. Whereas demand can fluctuate very quickly. Getting new supply on board is difficult and it is not happening as frequently in recent years. So there is a case for upside based upon demand supply, which is also a reason people would like to evaluate gold as an investment. So with these kind of 5 different ideas of why people think about gold, let me go into the performance of gold in the Indian context itself. So what you see, and this is the chart which I've taken from the World Gold Council. The sources are there in the base of the chart. What you've seen is over long periods of time. They look at 2 years, 5 years, 10 years, and this is true over a 20-year period. What you've seen is that gold has delivered positive returns over the long run, and in some periods of time, the last 2 years being the most clear example. We all have a recency bias, regardless of how difficult, how hard we try to prevent it. What you find is that gold has delivered significant positive returns, and returns which are in some cases better than most other investing asset classes, right? And what you see, the chart on the right is particularly interesting to me because it actually talks about real returns, not just about nominal. Here, a lot of us are conditioned to think about returns in a nominal return framework, which is returns without adjusting for inflation. And all of us know that inflation eats away the value of our money, right? So if you look at the returns from a real return perspective, after subtracting inflation, and you divide the periods of time into low inflation periods and high inflation periods within India itself, what you find is that gold has done well in both low inflation and high inflation periods. But more importantly, if you look at the chart on the left, even in a low inflation environment, gold has generated substantial positive real return. So that I think is an important observation, which can help in how you think about gold within a portfolio construction. Now, the billion-dollar question, if you may, is how much do you allocate to gold, right? So, gold allocation is interesting. It is a good diversification. There are strong cases to be made to allocate into gold. I think that is beyond debate. But the key question for all of us as investors, as asset allocators, as advisors is how much to allocate. And here, there is no prescriptive way or no formulaic way in which you can say X is the amount of money of the portfolio which has to be put into gold, right? So it depends on the reason for allocation. Now, if you look at historical data, and I will be the first person to tell you, you cannot do forward-looking investment based purely on historical data. Historical data can be used as a guide to see what could happen in different scenarios, but you cannot use it as 100% reason to make an investment decision. But if you look at the last 10 to 20 years, what you find is that from an Indian portfolio context, if you look at a portfolio of Indian equities, for example, a 10 to 20% allocation in gold, while it does reduce average returns versus say the Nifty, it substantially reduces the standard deviation of the portfolio also. So if you're looking from a risk reward perspective, a 10 to 20% allocation, and the exact allocation varies based upon what your portfolio mix is, seems to reduce your average returns slightly, but reduce your standard deviation dramatically, right? At the same time, a higher allocation, let's suppose you decide a 30% allocation or 40% allocation, what that does is it actually reduces your average returns significantly without resulting in a substantially lower standard deviation. So there is a sweet spot, if you may, with regard to how much of an allocation can give you a good risk reward from a portfolio perspective. That's if you're looking at it as a diversification instrument. If you're looking at gold as a tail risk or a safe haven, these are not aspects which you can easily quantify from a portfolio construction standpoint, right? So in this scenario, you just have to go with analysis to some extent and a lot of intuition and gut, and trying to see what is the upside downside scenario from your portfolio or your client portfolio perspective. And if you look at the current discourse globally, you had large global investors talk about gold, a 5 to 20% allocation can be justified. That is a very wide range. I'll be the first person to admit that. But the nature of this discussion about how do you quantify tail risk is such that, any of these numbers could be well justified. I'll just stop there just to kind of gather some thoughts and see if there are any questions.
Krishna, if I may interrupt you with a question here. So again, if we look at, say, the gurus of investing worldwide, Warren Buffett very famously has said that if aliens from Mars were watching us, they'd be very puzzled that all this gold is mined with great difficulty from the heart of Africa, and then it's transported with high security and locked in a vault deep underground. And these Martians would be scratching their head and saying, what the hell? It's an asset where there's no income, there's no yield. And therefore, he famously has never sort of bought or suggested buying gold any time in his life. But at the same time, in the last couple of years, we've had a whole lot of the other biggies from the hedge fund world, Ray Dalio and a whole lot of others, Seth Klarman and others in recent months, who have all aggressively gone into gold. Some of them have even gone into Bitcoin. Of course, we're not going to talk about Bitcoin on this, but a lot of people say the attraction of Bitcoin is that it's millennial gold. So in the light of all this, is something changing right now where at least the perception to gold as a financial asset is changing? Because at least what I used to hear from people I used to talk to even within the investing community in India is that my wife has jewelry, why should I have an allocation to gold? So is that changing? How did you see that during your time when you were interacting with a lot of gold investors at MMTC PEM?
I think definitely, there has been a rethink in the last 6 to 12 months, I would say, about how people are thinking about gold as an investment asset. And I think a couple of reasons to drive that. One has been just the sheer price performance itself. Because gold prices have gone up as a function of demand supply, and the marginal demand seems to have come from some central banks based upon the data, you've seen gold prices tick up over the last 12 months, right? So typically a price increase by itself gets an interest. because people look at past performance and they try to understand what is happening, if there is a case for continued returns, etc. More recently, if you look at the COVID pandemic and the response of central banks to the pandemic, as well as what's happening globally from a monetary and fiscal policy perspective, it is very clear that there's a lot of spending pretty much every country is doing, right? And in about a couple of hours, you'll get the US non-farm payrolls number, and you'll see how bad the US economy is doing right now. So all this has led to a lot of demand for stimulus and a lot of demand for further easing of rates. And this kind of a scenario tends to be very positive for gold, because if and when people lose faith in their currency, gold is still an asset where you can go into, which is borderless and which can be used as a good store of value. And the gold as a store of value has held the rest of time for hundreds of years, right? So that characteristic hasn't gone away. And while people can argue about what is the ultimate utility value of gold, there's a small portion of gold which is used in technology. So your phone, for example, has a small amount of gold, and jewelry is probably one utility value. Beyond that, you can argue that gold doesn't have much utility value in terms of what it can do as a metal. The reality is, from demand supply is what drives prices. And in a scenario like the current, where there's a lot of pressure on fiscal policy globally, monetary policy is super easy. One can see a scenario where the demand supply gets tilted in a way that prices could go up further, which is what a lot of the larger investors like Seth Klarman or Ray Dalio or Elliott, the fund, Paul Singer, they've all been saying about this. Absolutely. So with that as the context, let me just go into, how is gold priced in India, right? Because while we all talk about gold, we see the price of gold, every newspaper, whether it is a small newspaper in a small town or if it's Economic Times, every newspaper has the price of gold given prominently, right? So you can go into a small second tier, third tier town in India and ask a housewife, what is the price of gold? And chances are, even today, people will tell you the price of gold with an approximate 5% kind of a range, right? So people, whether it is men, women, etc., have a very good sense of where gold prices are. But how is that gold price arrived at is something which is an enigma for a lot of people. So what I'll do here is take a couple of minutes to walk through the gold price, what you see in the newspaper or on TV. How is that arrived at? How does that happen in India? So what happens is, gold globally across markets, the price is derived off of the spot price in London. So the LBMA has a fix in the morning and in the afternoon. Gold is a commodity which is traded 24/7, but there also, spot prices are available from different sources. And that spot price, typically it is quoted in dollars per ounce. For example, yesterday, it was about $1,700 per ounce per troy ounce. A troy ounce is just over 32 grams, is what is the spot price in London. You take that and multiply it by the dollar INR rate, the spot exchange rate, right? So that gives you the price of gold in rupees per ounce, effectively, after its conversion. Now, this is the price in London. Then you need to add a customs duty, because the government of India imposes a 12.5% customs duty on gold. Now, this duty is ad valorem, it's on the value of gold, but to make life, easier for everybody, the government declares this duty in rupees per 10 gram terms every fortnight. So while the gold price might go up and down during the fortnight, the duty for the fortnight is already decided in advance, right? So you need to add that duty to the price of gold derived from the London number. And then there is a unique characteristic, which is basically a premium or a discount, which is applied based upon domestic demand supply conditions. For example, in Kerala, if there is a lot of gold which has come out because of recycling from different sources, then in Kerala, there might be a discount on gold. Whereas in the Delhi market, you might see there's a lot of demand, not enough supply. There might be a slight premium over the amount or the number which is derived by the first three factors. So there is a small physical premium or a discount. And which is also the reason what you find within India also is the prices of gold vary by city. So there's a different price of gold in Coimbatore and different price of gold in Mumbai, right? So this is how gold is priced. This combination, this formula is what is used to get to the Indian price. What I've provided in the table below is a comparison of what it was a year ago and what it is currently, right? So currently, for example, about 46,000 rupees per gram, per 10 grams is the current price of gold. A year ago, it was about 32,500. So you've seen a 40% increase in the rupee price of gold in the last 1 year. And as a lot of you might know, gold is probably the best performing asset class in India. It has beaten fixed income, it has beaten equities in a big way because of this increase. At the same time, suppose you had a way to be long gold in US dollar terms in London instead of buying gold in India. Then instead of 41%, the increase is only 31%. So you made a larger return by holding gold onshore than gold offshore. Why is that? Because when you hold gold onshore, the fluctuation in the dollar INR and rupee has depreciated substantially in the last 1 year, also adds to the return profile of gold. Similarly, any change in customs duty also impacts the price of gold and the returns you have from holding gold in India. So customs duty in the last budget went up from 10% to 12.5%. So that resulted in an immediate 2.5% increase from a return perspective, because suddenly gold in India was 2.5% more expensive than before the budget in July, right? So these are all the factors which together lead to the price of gold in the domestic market itself. In case you have any questions, I'm happy to kind of dig into the details here.
So again, Krishna, we have one question on the earlier section, which I guess we can take now, which is linked to the point where you said that 20% allocation is pretty much where there's some point on a continuum where risk is optimized with gold allocations. Now, is that backed by any theory? Are there any papers available which we can actually share with our audience later? Or
there have been articles in the newspapers. I think Mint carried an article a couple of weeks ago which spoke about the returns of gold under different allocation conditions. I'm happy to send a link across to that article.
Okay. And again, the other point which I think struck me, at least when I looked at that table which showed the gold returns over the last 1 year, is that if you're a domestic retail investor in India, then pretty much if you are looking for dollarization of portfolio, then gold is actually a pretty impressive asset class to actually meet that criteria. So if you're looking at dollarizing portfolio without actually getting into the hassles of LRS and remittances overseas and actually holding foreign currency, then probably gold is the best option for dollarization of portfolio, or do you see other options which are equally attractive as gold?
I think gold is a great option, and this has been true not just in India but across emerging markets. So if you look at economies where currencies have been very volatile or have had great depreciation bouts, you find that gold is an asset which a lot of households tend to embrace. And I think in our neighborhood, if you look at Thailand and Vietnam, both of these are countries in the last 20 years where they've had bouts of depreciation. The amount of gold held by households for savings is much higher than what one would expect. So as a dollarization proxy, gold is a very accessible retail asset. Absolutely agree with you.
Okay. So in a sense, the Indian housewife has always had a lot more wisdom than she's perceived to have had.
Absolutely agree on that. Absolutely. So I'll just quickly talk about the purity of gold and what it means, because there are some technical kind of points which people might appreciate here, given that it's not an asset which is typically handled physically by most investors. What you find here is the market terminology for different purity levels of gold. 18 karat gold is what is typically used in jewelry for fashion jewelry, right? A lot of the housewives would be buying 22 karat gold. Now 22 karat gold is also the gold which is used for making some coins like the British sovereign, the South African Krugerrand, etc. Right? So some of these coins which are traded in global markets tend to be 22 karat, which is 916 parts of gold per thousand. Now 24 karat gold, which is what we call as pure gold, is gold which is typically 995 parts of gold per thousand or higher. So whether it be 995, 999, all of those are called 24 karat gold. And these are typically used for investment purposes because gold at such purity tends to be very soft. So you cannot make jewelry which is durable with 24 karat gold, right? So now if you look at the fineness, what we spoke about is caratage. That's one way to measure purity. The other way to measure purity is fineness of gold. And there within 24 karat, you have 3 grades typically: 995, 999, and 49s. So what happens is, gold is refined through a chemical or electrolytic process. So removing every incremental impurity tends to be substantially harder than the previous percentage point. So when you try to take gold from say 916 purity to 995 purity, there is some amount of effort involved. From 995 purity to remove that 5 parts of per thousand and reduce it to 1 part per thousand of impurity, to remove extra 4 parts, is substantially harder than what it took to get to 995. So, not all refiners are able to produce 999 fineness gold. Now, from 999 fineness, if you want to go to an even higher purity, which is called 4 nines, which is what is used for gold coins, like the Canadian maple leaf, one of the well-known gold coins globally, you need to go to 4 nines fineness. Now, from a market perspective, though, whether you try to sell somebody 999 gold or 4 nines gold, in the Indian market at least, people don't recognize or pay you much of a premium for the effort involved. You could get a small premium to account for the fact that there is more gold in 4 nines than in 3 nines mathematically, but there is no extra premium one would get for the effort involved in refining gold to a higher purity, right? So what I will do is now for the next 15 minutes, go through quickly what are the different options available for gold investing in India. And then we'll go through the pros and cons of each option. Because look, I think the reality is everybody has a different way of thinking about gold as an investment. People have different conditions with regard to their portfolio sizes, how much they can allocate, what kind of liquidity they need, etc. So it is very difficult to say that any of these is de facto the best way to invest. But it is important for us as allocators, as investors, to think about the pros and cons, which is what I will do for the next 10-15 minutes. And how will we evaluate these different options? I will take a minute about this. One is cost. What I mean by cost is, suppose you buy gold in one of the forms. I put out 9 forms of gold there. Suppose you buy gold and turn around a minute later and decide to sell it, right? So what is the bid offer, if you may, for buying and selling a full round trip? That is a good way to look at what is the transaction cost involved for each form. We'll look at that. Second is the tracking error. Because, to what extent does the investment option track the underlying price of gold itself? Because you might do an analysis on a price of gold, but if your investment option doesn't track it very well, then that introduces further error into the portfolio construction. Third is liquidity. How easily or how difficult is it to convert what you've invested in into monetary currency, right? Into currency. Fourth is access. Are there special accounts required? Is there a particular hurdle with regard to minimum amount to invest in a particular kind of gold, etc. Fifth, we'll talk about taxation. And taxation is 2 parts here. One is from a GST perspective, because some forms of gold, you will need to pay GST. Some forms don't have GST levied on them when you're investing in them from an investment purpose perspective. And second, there are some forms where it's the tax advantage is there from a wealth tax perspective or capital gains perspective. So taxation should be looked at, because I think ultimately all of us are here to maximize post-tax returns on our portfolios. And finally, there is an element of risk in every investment, which goes beyond the tracking error. And it's important to think about that also, I think. So now if we just go through the list of different options, right? Jewelry, which is I think the most widely used option across the country. The advantage is it's easy to acquire. There are more jewelry shops in India than there are bank branches, right? So that's how ubiquitous gold is within the Indian mindset, and access to gold is very easy. But the negatives of investing in gold via jewelry are multiple. One of which is a high markup. So when you buy jewelry, there is a price of gold, then there is a making charge, which is typically levied. Then there is a wastage, which is levied in many jewelry shops. So what you end up paying for is substantially more than the commodity value of gold in the jewelry itself. Then, given that jewelry is not pure gold, but it is gold which is mixed with either silver, copper, different kinds of alloys to make it to 22 karat or to 18 karat, the resale value suffers, because it is, especially in the Indian context, if you go and sample gold across say 50 jewelers, you'll find significant number of instances where the gold may not necessarily be to the purity which was stated for a variety of reasons. So there is a resale value becomes questionable. That also is a big negative. And finally, there is GST. There's a 3% GST levied on gold jewelry. So when you buy gold jewelry, you have to pay that GST. There's also a higher GST on the making charge. All of this gets lost when you try to sell the gold again. So that's again a big negative for jewelry itself. Then if you look at physical gold, which is in the form of gold coins and gold bars, And within gold bars, I should say there are two kinds of gold bars people can invest in. One is the cast bars, wherein, if you look at the bar, it doesn't look very shiny, right? And then there is what is called a minted bar, wherein the bar, there's a lot of work which goes in to polish the bar to make it look nice and shiny. Minted bars usually come with a slight premium because of the making effort involved versus the cast bars. But when you're buying it, you can either buy physical bullion, can go in coins or in cast bars or in minted bars. The advantage is there's direct ownership, right? So you own the bar, you take it home with you and you store it in a safe place. But the disadvantage also is that there is usually a markup versus the commodity price, depending upon the size of purchase. If you decide to buy one 5-gram coin, you can't expect to get the same price as what you would get in the Mumbai bullion market. There will be a markup for the supply chain, for the cost involved in getting that coin across to you, right? There's also the cost of storage. Now, one can argue that how do you quantify it? Suppose you buy enough gold to put it into a fixed deposit locker. There's the cost of the locker. There's the cost of ensuring that the gold is stored properly, insurance costs, etc. Right? So there is the cost there for storage. Also, getting a good price on liquidation depends on how well you can access the market. Suppose you take a 5-gram gold coin with you today and go to 5 different jewelers. It is likely that the 5 jewelers will give you a different price for the same 5-gram coin. So if you are patient, you'll be able to get a good price by doing a price discovery. But otherwise, you might have to take a small penalty, if you may, on liquidation for a physical product. And then, of course, there's GST. Now, GST is applicable at the same rate for both jewelry as well as for physical gold. Then, of late, especially this year, because Akshaya Tritiya was under the lockdown period, there's a lot of discussion about paper gold. Different jewelers have put out gold savings certificates, paper gold plans. And, the idea is that you can buy gold in a certificate form from the jeweler. But the negative here is the creditworthiness of the jeweler decides whether or not you can make returns of it. This is one of the risks I spoke about, right? Only a few jewelers currently issue them. They're largely illiquid. So you can't go into the market and sell one jeweler's certificate to another jeweler. And you can only convert them into jewelry. Coming on to financial products, which give you the return profile of gold. Gold ETFs obviously are a very well-known product. They are highly liquid. And in India, most gold ETFs hold gold in physical bar form. Overseas, you do have gold ETFs which own future contracts in the back end, and those could lead to some kind of tracking errors from time to time. We've seen a similar issue happen in the oil market recently, where one of the large oil ETFs had a huge tracking error. But gold ETFs in India are highly liquid and own physical gold. The downside is that there is a small fee involved typically for managing the ETF. And that's you need to have a demat account. So access becomes slightly more difficult. Not everybody can buy it, unlike jewelry, which every housewife can buy. So that's the con of a gold ETF. There are future contracts. You can buy one on MCX, for example. And future contracts are very interesting because you get a lot of leverage, which is also a negative. The big downside is that these contracts are time limited. You get a lot of liquidity in the front month contract. So you need to roll these contracts every month. And there's some cost of roll and there's some effort involved in rolling them at the right time. There might be some roll related slippage also, which could occur to your portfolio. Going further, there is one proxy a lot of people have used, which is a gold mining focused mutual fund. Because the thought process is that, look, if gold is buried in the ground, then the miner owns the gold mine. It should have good value, like gold which is in a vault, right? You just have to extract it and sell it. So, and historically also, stock prices of gold miners and gold mine funds, mutual funds, have tracked gold substantially. But from time to time, and I think the current scenario is one such time, where you could have a large tracking error between the price of the gold mine mutual fund and gold price itself. Also, there are other factors like geopolitical risk. Because a lot of gold mines are located in areas where the underlying political conditions are not necessarily stable. So there could be mine seizures, there could be taxation, etc., which could change the value of the mine itself. So that's one more risk to think about. On the contrary, you could have some upside also. If there is more gold discovered within the mine, your price of the gold mine stocks and hence the mutual fund could increase.
Krishna, if I could interrupt you with a question here on gold mining funds. So this is again something which has interested me. that particularly when you have a gold bull run. So a lot of people believe that gold mining equities behave like a levered form of gold. So you're actually getting gold with an enhanced beta, because really you are having a fixed cost structure which is already determined, where the gold mining company is already profitable, and therefore the increase in price of gold actually means that it's a straight flow through for whatever is extracted from the ground as a flow through to EBITDA and cash flow and profits, as well as at the same time it means an increase in value of the inventory, as you mentioned, which is underground.
Right.
So a lot of speculators at least flock to these instruments, and probably if we go back to the Great Depression, 1929, and the nationalization of gold in 1934, 1933 by President Roosevelt, we actually see that probably for a US investor in the 1930s, gold mining equities was the only way to actually avoid that nationalization. Now, with that sort of background, I know for a domestic investor in India, I think there's only one such mutual fund available, which is, I think, the DSP World Gold Fund. And
Yes.
that actually has given, I think, a 65% return over the last 1 year. But for LRS investors, gold mining equities, it's itself a huge field. But I think the challenge where I'd like to hear your views is that in many of these cases, you hear of cases where, again, you have companies which have either gone in for forward contracts. You have companies where you have, as you said, the risk of expropriation of assets. So you have all sorts of oddities which actually make this significantly more risky. So any views on this?
Sure. I think, you kind of captured the pros and cons very well. The logic for saying that a gold mine ETF or a gold mine fund is a levered bet on gold, given the cash flow profile as well as the inventory which is in the ground, I think is very well tested. And that is true for a lot of the larger gold companies. And potentially, as you see cost efficiencies, you could see a further upside from, the scale of these companies itself. And that's proven over time. The hedging part of it, what we see is that many of these companies hedge their near-term gold output. So it is not that they're hedging out their 3 to 5 year kind of gold sale, but more in the 1 to 2 year horizon, just to make sure that their capex plans, their spends don't get affected by a big swing in the gold market itself. So you may not see the benefit of gold price flowing through to the cash flow immediately because the hedge in place, but over a medium term, long term, you do see the benefit of that. Absolutely, yes. But to me, I think, the tracking error comes in also because of the risk of expropriation, because a lot of gold mines, especially the ones discovered in the recent 10 to 20 years, have been in, locations wherein the rule of law is not necessarily very strong. And that to me is the largest potential risk for a fund like this. But I agree with all of the parts of the thesis, as you said.
So we in fact had a blow up of that sort last week itself, where I think Barrick, which is one of the largest gold miners in the world, found that Papua New Guinea government is not actually renewing its mining lease. And I think the stock fell 10% in 1 day on that news. So
absolutely,
yeah, I think
so that's the risk with doing business in countries which are tough from a governance perspective. From the India perspective, I think the sovereign gold bonds are an instrument which I tended to like a lot for a variety of reasons. If you're comfortable with the sovereign risk, of course. One is the pricing itself is attractive because you get a discount versus gold prices when you buy these sovereign gold bonds, especially when you pay in digital form, right? So that's in the primary market. And even in the secondary market, from time to time, you see a divergence between the pricing of sovereign gold bonds versus the underlying gold price. There is an annual interest component. So, Kazi, going back to the Buffett quote of gold is an asset which doesn't give you any returns. I think the one exception to this broad rule is the sovereign gold bond, because the government of India gives you a 2.5% return every year on the amount in gold terms, whatever gold you buy and keep in the form of sovereign gold bonds. And also tax benefits which are specific to sovereign gold bonds, which you don't get with normal gold itself, be it bullion or in ETFs. But there's of course the issue of liquidity. This is less liquid than ETFs, so your transaction cost could be higher. And this is government issued. So if you're in the camp that you would rather want to use gold as a way to not have the government, risk embedded, then a sovereign gold bond has the correlation risk, if you may. And if you want to buy sovereign gold bonds in substantial size, given the illiquidity, it is best done when the window of issuance is there. Doing it in secondary market leads to much larger impact cost. Right. Then I'll go to the last couple of options here.
So Krishna,
one is, of course,
if I could interrupt you with two questions. So Krishna, if I could interrupt you with two questions from our audience on sovereign gold bonds. So
sure.
One question actually, which is one which I remember the two of us discussed the first time we spoke on gold. And this was, what's in this for government of India? How come they can afford to give 2.5% coupon on gold while nobody else can? So, what makes them be so generous that they're willing to absorb all storage and security costs? And
sure.
The other question is, how come these SGBs actually trade at a discount to NAV? So why are they not priced efficiently? I just thought I'd interrupt you with these two questions now itself rather than.
Sure, thanks, Kazi. So, from the Government of India perspective, I think it's important to read the fine print behind the sovereign gold bond, right? Now, like this year, for example, in the budget, the government has said they want to do about 10,000 crores of government borrowing through the sovereign gold bond scheme. That means this is money which is going in to fund the government deficit. Now, by extension, and this is very clear if you read the fine print, it is not that the government is going out there and buying gold against your sovereign gold bond. Suppose you buy a sovereign gold bond of 10 grams. It is not leading to a 10-gram purchase of gold by the government of India, right? What the government of India is telling you is, look, I will give you returns in line with the price of gold and give you cash based upon the gold price at the end of the 6-year or 7-year period. That's what the promise is. It's a promissory note where the payment is linked to the price of gold. And this is what enables the government to give you the interest also, right? So what the government is telling is, I'm giving you 2.5% interest on what you've given me in gold terms. And by the way, 2.5% is typically what you would get for metal leases in many markets. So it's not something which is a number which is drawn out of thin air. So when you suppose you have gold in a bullion vault in London and decide to lease it to somebody, so they can borrow the gold and they can use it for their purposes, then the metal lease rates tend to be between 1.5% to 2.5% based upon counterparty. Again, market conditions vary, and now is a difficult time in the markets, but regardless, right? So what the government is doing is giving you a market-like rate in some sense, and this is being used for deficit financing. So that's why it is different from you buying gold bars and keeping them in a vault where you don't get any interest and you incur all the storage costs as an individual, right? Coming to the second question of pricing itself, look, sovereign gold bonds, while they've been around in the market for the last few years, the liquidity in the secondary market has been poor because the instrument is not well discovered, right? So if you look at how many people are comfortable understanding the pricing dynamics, the return dynamics of sovereign gold bonds, it is not too many. It's not been marketed to a level, of say a mutual fund, right? While there are more people who own gold in India than people who own mutual funds in India, because a lot of gold is owned as jewelry and coins. If you look at number of people who own a sovereign gold bond, it is very few at this point of time. And that explains why the market is still not efficient. But over a period of time, I would expect this pricing, discrepancy to reduce, if not disappear. And that's going to be a function of, time more than anything else, and the market deepening. So I'll just go into the last couple of options here, what we want to discuss. One is digital gold. And, I had the privilege of being able to launch digital gold in India through Paytm a few years ago. And now it's available through multiple payment platforms and bank platforms. The benefit is it is easy access. You can buy and sell anytime, any day, anywhere at a single price for the whole country. So unlike physical gold, where the price varies from location to location, and if you're in a tier 2 or tier 3 city, the price of physical gold is typically higher than what it would be in a tier 1 city. That's not true in digital gold because it is being made available through a digital platform, right? Also, the whole concept was to democratize investing in gold. Even if you have 5 rupees to invest, you can still buy digital gold. You can't buy jewelry for 5 rupees or even for 500 rupees, but you can buy digital gold for 5 rupees. So the idea was to make gold investing accessible to everybody. Now, obviously, when you make it as accessible, it comes at a cost, which is that this is expensive versus other investment options. So if you look at the buy sell differential for digital gold, or if you use the test I suggested earlier, saying if you buy now and sell immediately, how much do you lose, right? In digital gold, the total cost of a round trip buy sell is between 6 to 7% based upon day of week, because there is a markup or a margin which is there, and there's a GST component of 3%, which you don't get when you sell it back. So there's about a 6 to 7% cost of buying and selling digital gold. Also, you are inherently taking the risk of the platform and the digital gold provider, because you don't have the gold physically with you. You're taking an inherent view that the platform through which you're buying the digital gold and the ultimate provider of the digital gold, there are about 3 providers right now, they are doing the right thing, and they will be there to give you your gold when you want it. That's the inherent bet you're taking when you buy digital gold.
So Krishna, if I could just interject with one question here. So my understanding is that for these larger players, many of them would have this vaulted gold, and in many cases, this vaulted gold would actually be physically segregated as well. Is that a norm internationally for digital gold as a product or for vaulted gold as a product? And are those international best practices being used by these service providers in India as well?
Sure. So you look at gold and paper gold, digital gold form, right? Globally, there are 2 ways you can look at that. One is what is called allocated and what is unallocated. Allocated gold means what gold you're buying. Against that, you get told this is the bar number, and that bar is stored separately for you. That is allocated and segregated, right? So in allocated and segregated, you know which particular gold bar belongs to you, which implicitly means that you have to buy at least a gold bar. You can't buy 1 rupee of gold and expect to have a speck of gold with a number which you say that this gold belongs to Krishna. So what you have in India is allocated gold, but not segregated. So it's allocated in the sense that it is in a vault separately for the provider. There is a ledger, essentially a computer ledger, which says who owns how much of gold. So it is stored in the form of typically kilobars, 1 kilobars of gold. In some cases, it might be 100-gram cast bars also. And on the system in a database, it says who owns how much of that 100 grams, right? But it is not segregated. So there is one big pile, say a 50 kgs of gold is held by a particular provider. That 50 kgs will reference a database which adds up to 50 kgs at least. But it is not that the first 10 kgs goes to the first 1,000 people. That's not the way it is handled in the system right now. There are checks and balances. There's a trustee in place for most of these providers who is supposed to do a monthly check to make sure that what is on the system and what is in the vault correspond. So there is no deficit per se. So that is done through a trustee mechanism to get trust. So there are these checks and balances which are put in place. But from an Indian digital gold perspective, what you should know is this is allocated, but not segregated. There are options globally. There are none in India at this point, where you can go for allocated and segregated. So you know that that particular bar belongs to you. Many of the mints globally, Perth Mint, for example, provides this kind of a service. And coming to my final point with regard to the options, obviously there's an overseas option, given the LRS scheme which the government permits. You could, take money out of the country and invest in gold or in gold mining funds, gold futures, etc. All these are possibilities. And this could be a way for you to mitigate the domestic price distortion. Because today when you buy gold in India, an implicit bet you're taking is that the customs duty is not going to be cut. Because tomorrow if they cut the customs duty, the government cuts customs duty, the price of gold will automatically drop to that extent, right? Similarly, if you don't want the rupee exposure, dollar rupee fluctuation to affect your value, then an overseas option is possible. There is a minimum size which is required, which is high, to justify the effort involved in going through LRS. And there might be time constraints involved also in doing this. But one should look at it if you're looking at large enough portfolios, I would say. So what I've done next is I've just kind of put all these options on one table just to make it easy to compare. Again, the idea here is not to recommend one option as superior versus the another, because look, the reality is in many assets and gold especially, every person's kind of background constraints could change and vary, and there might be different options which work for different people. But my objective was to come out here and just put it out on one chart so people can take a a measured view of how to think about the different options. And this brings me to the end of my presentation. Happy to take questions going forward.
Thanks, Krishna. I think that was very helpful. We already have over 20 questions from our audience. And if any of you have any further questions, please do type it in the Q&A box on your screen. Now, so I think we have a couple of questions. I'll try bunching them up into questions of the same genre. So we actually have a couple of questions around. I know something which you're not going to be comfortable answering. So at the end of the day, a good time to buy gold, is it not? So I think on behalf of Krishna, I'll actually answer that question, that none of us here are offering an opinion on whether it's a good time to buy. Who knows? Maybe gold will double from here in the next so many 18 months, 24 months. Who knows? But at this, at least for the limited purposes of this presentation, none of us are actually attempting to answer that.
Yeah, and I think the point which we discussed earlier today was that, look, if you had asked me to make the same presentation a year ago or 2 years ago, the content would be exactly the same. The idea here is to put forward facts rather than have an opinion on gold prices or whether or not to invest in gold, and we will stick to that as the objective.
So we also have another question on the macro, which is with constant quantitative easing in the US and in developed market and negative interest rates around the world. Now, these will clearly benefit gold, but what could potentially be the longer term impact?
I think end of the day, pricing is a function of demand supply, right? That is true for all assets. It's more true for gold than anything else because it is an asset which has limited end utility at this point of time. So it's held as an investment asset. And, given when the interest rates are zero or negative, it's easier to hold gold because you don't have the negative carry in some sense of trying to fund it through a currency which has an ticking interest rate. So that makes it easier to drive up demand for gold. At the same time, given not just what's happening from a monetary and fiscal policy perspective, but also geopolitics of the day, right? If you look at from a global geopolitics standpoint at this point, given what's happening between China and US, for example, there are reasons to believe that there could be incremental central bank demand for gold as central banks decide to diversify assets. If you look at from a global standpoint, what you find is that developed market central banks have a larger proportion of their reserves in gold than emerging market central banks. So if you argue that the crisis is going to further push EM central banks, which have a lot of reserves, to diversify the reserves away from the dollar into gold to some extent, that could swing markets dramatically. And central banks are famously not very pricing sensitive because once they have a portfolio policy, they just kind of execute that, right? So there is an argument to be made, yes, but how does it pan out medium term, long term? It's very hard to say because if you dial back 12 years, like in 2008, a lot of the similar arguments were being made, right? And you had gold go up to $1,800 per ounce levels, even higher than that, and hit what we've seen as the highest point so far is not in recent months, what was about 12 years ago. But what followed subsequently was a period of time wherein rates stayed low, central banks continued to buy government bonds and expand the balance sheets, but gold prices did fall rather than rise as expected. So the counterpoint one would make is we've had one episode in the last 2 decades wherein you had a scenario where central banks expanded balance sheets, rates were very low and negative in some conditions, but gold prices did not spike up. But after a peak, they actually went down over an extended period of time. So that's a counterpoint. So, in all these cases, it's hard to say, but I think there are strong points in both areas.
So another set of questions are around gold compared to other metals. So in one case, comparing against some of the more conventional industrial metals like silver and copper. On the other hand, against other precious metals, whether it's platinum, palladium. So what has your experience been on looking at these alternatives?
See, gold and silver, people look at some ratios and tend to trade one against the other. That's been a very popular kind of a trading, view people take. But from a long-term portfolio allocation view, that's not obviously what we want to look at here. people have historically looked at precious metals as a group, absolutely yes. And based upon where relative values of different metals lie, there have been small allocation changes made, but gold tends to dominate from a total allocation within the precious metals bucket itself. If you look at palladium, if you look at platinum, both of these have had industrial uses increase over the last couple of decades, right? Whether it be because of electric vehicles, whether it be catalytic converters, etc. Industrial uses have increased dramatically, and the swing buyer in these metals is no longer the investment buyer, but it is industrial uses. Silver also has a lot of industrial uses, much more so than gold. So in some sense, the demand supply dynamics for these metals tends to be very different. So if you're looking at it purely from the aspect of saying, central bank demand or a hedge against monetary debasement or a tail risk hedge, I think it's hard to argue against gold as the candidate for this. But there could be points in time where a diversification into other precious metals could be tactically, useful.
So we have some questions also around whether like other asset classes and SIP is recommended for gold. So I think maybe you would have come across this in your experience in creating these products for retail investors.
Yes, and there are a couple of reasons why people tend to like the SIP concept for gold. Because one is this whole idea that, look, I want to save regularly, and gold is an asset which is close to my heart, right? So like if you look at jewelry shops have been running the SIP equivalent program for gold from a very long time. You go there, you pay 500 rupees every month, they write it on a piece of paper. End of 12 months, they give 1 month free and you buy a small piece of jewelry. That's been the way, millions of housewives have saved and accumulated gold jewelry in this country, right? So that is SIP in its kind of, in a different physical form factor, I would say. And same thing has been true. We've seen people do that in digital gold. Some of the platforms also offer an easy way to have a monthly plan for digital gold savings. And even in the absence of these plans, I've seen, consumers decide to set a calendar alert on their phones saying every Monday or every Tuesday, I'm going to buy 101 rupees of gold because it's an auspicious number. So there are different behaviors. And, one cannot argue that all these behaviors are purely driven from a returns perspective or from a rupee cost averaging perspective. But the conventional sense that, look, staggering investment over a period of time is a good way to rupee cost average in any asset which is volatile but trending upwards. If that is the view you have on the core gold price, SIP could be a good way to achieve that goal of accumulating gold itself.
Thanks so much for that, Krishna. I think we're almost running out of time, so I just try squeezing in one more question before we wrap up. So again, we actually touched upon this very, very briefly in between, but we have a question here from one of our viewers. Cryptos have a lot of advantages of gold while mitigating some of the drawbacks of gold storage, etc. So if adoption of cryptos increases, will that be bearish for gold, or are they on, in a sense, separate demand curves?
That's a wonderful question. I think it's a great question. And there's been a lot of debate on this, hard to have a conclusive opinion. But yes, a lot of people who look at gold as an alternative to monetary, to currencies, also look at crypto as an alternative, right? While I would not say that the set is 100% overlapping, there is a substantial overlap between the two. At the same time, if you look at the price movements for the two assets, the correlation itself has varied over time, right? So like gold, for example, right now is at, $79 per ounce levels. If you look at Bitcoin as a proxy for crypto, it is, and gold is 1700 is about 10% off its all-time highs. Bitcoin is 50% lower than its all-time highs, right? So if you just do a very basic check, even ahead of the halving, which is going to happen soon, you see that Bitcoin levels are much lower than what they've hit previously. So it is, there is an argument which is out there, yes, but data doesn't seem to bear out that it is the same buyer base and doesn't bear out the fact that over medium terms, these assets are strongly correlated. That's not been the case so far, at least.
Thanks so much, Krishna. I think that was very, very insightful. I certainly learned a lot, and I think there's certainly room for gold in all our personal portfolios, in client portfolios for those of us who advise clients. So thanks so much for sharing your insights. As a reminder to our listeners, please do complete the evaluation survey that will appear on your screen at the end of the session. A link has been sent into the chat box. And CFA Society India members may claim professional learning credits by logging in their online professional learning tracking tool. Thank you everybody for participating in today's webinar. I hope you found it useful. So thanks from
Kazi.
our side.
Thanks
Goodbye.
everybody. Thank you.
Thanks. Goodbye.